does in real life just because there's so many things to control. So, but that's not your problem. Guys, today we are going to be getting more into securities. I posted your midterm grades and I put everybody's bonus points in. I was really happy for the most part. We had a lot of A's and B's, and in fact, I think the lowest grades were like B minuses. You guys are doing just fine. We're going to be continuing chapter 16 today, which is all about securities. When I say stocks and bonds, I mean securities. So we're going to be talking about how you make money in the markets. What we're also going to be doing, I debated about whether I'm going to show you guys a stock aggregator today or Monday. It's going to be easier on Monday when we're all in the same room because we're going to break back into groups. And I'm going to help you guys start thinking about what stocks you want to pick. Now, our next assignment that's due here is until the 12th, and don't worry about doing it yet. We're going to do an example of it in class, so you're going to get to see how the stock game actually works. So we're going to be doing that on probably Monday together. But we want to get in a little bit today, guys. I think I got our groups all correct. And I love some of these names. We got the Ben Franklins, we got the Blackjacks, we got Stratton Oakmont, GED, Get Every Dollar, love it, Team Spaz, and I would love to know where this name came from. Holy Glucose. That's a fantastic name. Will somebody tell me, where did that name come from? And Dawson's just shaking his head. It's like, it sounded good. It sounds great. Like, Holy Glucose. If you sold that as like a diabetes medicine, people would eat it up. Holy Glucose. All right. But guys, we're going to be talking a little bit about interest rates to start off our conversation today. Guys, here's one of the tricks. Who ultimately, does anybody know, in terms of how money is lent to banks? Because banks lend money to us, but banks occasionally borrow money from the federal government. So the federal government sets a minimum interest rate. Typically speaking, when the economy's not doing so well, we level off the interest rate so it's easy to lend money. We want to get more money in circulation. I'll be really impressed if somebody knows this. If we have too much money in circulation, what happens? It's a word that begins with an I. If everybody's got money to spend, what happens? Does the price of goods and services go up or down? It goes up. And the word associated with up, it begins with an I, is inflation. So guys, I'm going to show you a little video that sort of explains what happens in terms of inflation and how that affects the markets. We're going to talk about it a little. We're going to spell this out a little bit about how interest rates really play with everything. Let's talk about this for a second. So we know, for example, the Feds set an interest rate because the federal government lends money to banks. We call that the federal interest rate. What happens when the economy is bad and we want people to start spending more? We lower the interest rate. In fact, our interest rate for the longest time has been right around zero to lend to banks. So the government's not charging anything to lend money to banks, so banks will lend more money to people. Well, let's put it this way, guys. If you had an option, let's say you have two options here. You can put your money in the stock market and make a 5% rate of return, or you can put your money into savings and earn no rate of return at all other than you've got a place to put your savings. Where are investors going to put their money? Are they going to put it in a savings or are they going to put it into the markets? What do you think? So we get 0% rate of return if we put it into savings. We have a volatile but chance of making much more money in the markets. Where are the investors going to put their money?
The market.
You got it. So here's what the trick is, guys. When the interest rate is low, more people put their money in the markets. And if you want to know, for example, over the last 4 years or so, why the markets have been going so crazy, one of the big reasons is because interest rates are low and investors are saying, why am I going to put my money into savings where it's not going to grow at all when I can put my money in the markets and make money? Well, here's what happens. We see now we've got too much money in circulation, which is what the Fed is saying at this point. They want to raise interest rates, so it costs a little bit more to borrow money. The fear is that people are going to put less money in the markets for two reasons. The first reason is you don't have as much money because you're paying more in interest rates. How many of you, actually I'm going to turn off the share for a second. I kind of want to see all your beautiful faces here. Guys, how many of you, by show of hands, everybody has a credit card? Yeah, I got a credit card. Who here knows what the average credit card rate is in the United States? guesses? We'll do it by ranges. How many people think it's higher than 10%? How many people think it's higher than 20%? The average credit card rate in the United States for most consumers is over 20%. What that means is the average person who owes $4,000 on a credit card will never pay it off. That's a whole other discussion. But here's where we're going with this. If we've got low interest rates and people putting money in the markets, for example, credit rates tend to stay lower. At least they don't go up. When we reduce the amount of money that's in the markets, if we raise interest rates, guess what credit card companies do? They raise their interest rates too. They want to make money. And this sounds like a very glum picture for everybody. We're all paying more to borrow money. Well, here's the trick. It makes something more attractive to investors. Can anybody guess what that is? What is something you can invest in that pays you interest? Does anybody know? We know stocks can gain money in the markets by appreciation. There's another thing that begins with a B. What word am I talking about? Bonds. If you remember this, guys, you will master this chapter. A stock means you own a share of a company. That means when the company performs well, you make money. A bond means you've essentially lent somebody money. So when you buy a bond, if you buy a U.S. savings bond, you're lending somebody money, and they have to pay you back with interest. So when interest rates go up, typically speaking, and this is a vast oversimplification, investment in the market tends to slow down because there's more expenses for everybody, and more people start buying bonds because bond rates go up. So when the market goes in the tank, more people put money in bonds. Does that make sense, guys? With me so far? I know it's a Friday, and this is way less exciting at some level than talking about banning curling, but it's important. So we're going to be getting into this today, guys, because we're talking about two key concepts here. If you want to be invested in the markets, you really need to know the difference between stocks and bonds. So let's get in a little bit here, guys. We talked in the last couple of classes about how companies are able to make their companies work financially. If your company is doing well, you can get what we refer to as an unsecured loan. And here's the trick, guys. A lot of companies in the United States don't have enough money to make payroll. There are companies that literally borrow money every month to make their payroll. Who here can tell me what's the biggest time of the year for retail in the United States? You got it. Christmas. The Christmas shopping season, by some accounts, if you're a retailer like Macy's, or I'm trying to have another good example. Macy's is a good one. Best Buy is a good one. People buy televisions. They buy luxury goods at Christmas time. Some of those companies rely on Christmas and the holiday shopping season for 30 to 40% of their total income for the year. That means they're cash rich from November to January. The rest of the year they hit some shortfalls, and they got to borrow money to make payroll. And those are referred to as unsecured loans. If you get a secured loan, you got to get collateral. Then you get accounts payable, and that means you essentially are buying from other places on credit. You got to pay it back at some point. You can get bank loans, for example, but you've got to have a line of credit, and they're going to want some collateral. And then we also get something called commercial paper. And what that means is a company gets what we refer to as an IOU with another lender, maybe not even a bank, somebody who's agreeing to lend you money. That's a way you can finance your company. If we get into long-term financing, we're talking about debt versus equity. This is really the thing that you need to understand the difference between debt and equity. If we're talking debt, we're talking bonds. If we're talking equity, we're talking stocks. It's time for a question, guys. My question for all of you. You have a company, and you want to expand your company, and you need cash to do so. You've got two options. You can either issue a bond, which means you're going to borrow money, or you can issue stock, which is equity, which means people own a piece of your company. Under which scenario are you giving up more control? What do you think? Take a guess, guys. Go for it, Mario.
Definitely giving up more control when you get into your business. I think a loan is better if you're soon as you give up a percentage of your business, it's very, very hard to get back, and you probably will never get it back. But a loan, you wouldn't be trying to start up a business if you didn't believe in your business. So a loan shouldn't be that big of a leap of faith for you.
Mario, you nailed both the ideology and the technicalities of it. Here's the deal. Like, for example, if Tonkin's Chicken Shack is ready to expand because our sales are going through the roof, Chick-fil-A's lines are too long, Popeyes has too much breading, we're hitting the sweet spot. We're giving you guys light meat or dark meat, whichever you want, with just the right amount of breading, and Kent Tonkin's special chicken sauce. It's amazing. People love our sandwiches. So we got to expand. Well, if I issue stock and you guys all buy shares of stock in my company, you're shareholders now. So guess what? For every share of stock you guys have, you have a vote in matters that the company controls. If you decide that you don't want me to expand any further, you can control those things. If I take a bond out and I borrow money from you guys, I have to pay it back. And I have to pay it back with what? If you borrow money, what do you also have to pay? You got to pay interest. It's a legal obligation. You got to pay interest. That is the big difference between debt and equity. And we're going to talk about what the advantages and disadvantages are. So the difference is between debt and equity. Debt means you owe somebody money, but they cannot tell you how to run your company. If you have equity, and that also includes things like crowdfunding too, by the way. By the way, has anybody here ever been a part of a crowdfunding campaign? I'm going to tell you guys a little story about crowdfunding. You may say to yourself, wow, I didn't expect to hear a story about crowdfunding today. Well, today is your lucky day because I'm going to tell you a little story about how crowdfunding works. Let me just stop screen sharing for a second here. Oh, my slides are going nuts. There's too many buttons for such an old man. Guys, here's the way the crowdfunding works. Let's say, for example, and by the way, by show of hands, has anybody ever contributed to a Kickstarter? Okay, well, I'm going to let you know about something you guys are going to know a little bit more about my life than maybe you thought you were going to know today. How many of you, by show of hands, have ever seen my office, by the way? It's full of, what's it full of, Nicole? It's full of Batman, because I own more action figures than the average 8-year-old ought to own. It's what you can do when you're an adult and you have disposable income and you can buy really dumb things. There was a guy back in the 90s, and his name was Todd McFarlane, and he created a comic book that was a big sensation. The comic book was called Spawn, and people my age who were comic book readers love this comic book. We remember it because we grew up with it. Well, last year Todd McFarlane came out and appealed to all of us 40-somethings and said, hey, look, I'd really like to make an action figure just for you guys because you're old people that still play with action figures, and I know who you are. He gave me an opportunity to give him $40 to be able to buy a limited edition action figure. He tried to raise $500,000 because $500,000 is what it would take to be able to enable him to build all these action figures. He ended up getting $3 million. And so it was a large cash flow. He was able to do what he wanted to do, and he didn't have to take debt to do it. However, the equity share in this is now he owes me what I paid for. This is a new form of investing called crowdfunding. And the reason that's important to know is because do you have to typically be a big company to issue stock? Yeah, you do. This kind of equity investing is something anybody in this room could do. Any of you could start a Kickstarter and fund your own company with equity financing. This is a big deal because we're talking about, in the same way that we had people take over the stock markets a couple weeks ago with GameStop, this is a way that people your age can start companies, and that's why it's such a big deal. And so I'm really excited. I'm going to be getting my action figure at some point in time in the next couple of weeks. And yes, if you tell your parents that you're paying to go to a school where your teacher plays with action figures, I'll totally own it. Because you know what? Everybody's got to have a vice. And what I tell my wife, you can quote me on this, my action figure addiction is still cheaper than smoking. That's better for you. So that's the difference between debt and equity financing. Parker, you're saying to yourself, man, this guy has problems. I got issues, don't I? It's okay. You know what? We all got issues. We all got our hang-ups. And you know what? There are worse things in the world than action figures. By the way, when you guys were kids, I'm going to stop for a second because my slides are going nuts. and I got to get back where I was going anyway. How many of you as kids had a favorite toy? What was your favorite toy? Was it an action figure?
Yeah.
Like superposable?
It wasn't opposable. It was like stuck in like one position.
Do you still have it?
Yeah.
Oh man, prized possession. Spider-Man ruled. Who else had a toy they loved as a kid? Oh, come on, guys. It's Friday. We can be honest with each other. I just bared my soul with you guys and told you how much I spent on toys. And I also said I hated curling. Who else has a toy that they loved when they were a kid?
I loved Transformers.
Who was your favorite?
Probably Bumblebee.
Bumblebee, yeah. Do you still have Bumblebee?
Yeah, I do.
Oh, that's awesome. See, we got some brave souls in here. Who else had a favorite toy when they were a kid? What was your favorite toy?
I had an Optimus Prime toy. It was my favorite.
Oh man, Optimus. Like, which one was it?
It was like, I don't think it was meant for my age group. It was like really complex, and every time like I wanted it, like you could like make it the truck or the like robot, and every time I wanted it like in one or the other, I made my dad like put it to the right one so that I could play with it.
That sounds awesome. Optimus Prime was the best. Nicole, what was your favorite toy?
Well, I have two older brothers, so my favorite toy was a Power Ranger.
Power Rangers were awesome too. They're still cool. So you guys see, we got some good stuff here, guys. And what we're going to get into now, though, is the difference between debt and equity financing. Since we've talked a little bit about toys, and I see that I'm not the only one in this room who still likes toys to some extent. Guys, what's the difference between debt and equity? The difference between debt and equity is if you're financing with debt, yes, you can do what you want. You borrow money, you can do what you want with it. You have control. The people who you borrowed money from can't tell you how to run your company. If you're doing equity, yes, they can. If you have common stock, you can vote for the board of directors. What about claiming your assets? If you don't pay a debt back, for example, people can come and sell off things that are worth money to get the money that's owed them. With equity, I want you guys to remember this, guys. When you buy a share of stock, is there any guarantee you're going to make money on? None at all. It's like gambling. It's like organized gambling, but it's like gambling. Now, when a stock or a company makes money, a company can issue what we refer to as a dividend, which means they're going to pay you. Like, for example, I own a couple of shares of Planet Fitness, and they paid me a dividend. Get this, guys. I own 2 shares of Planet Fitness. I've owned them for a year and a half. I've literally made $1.25 in dividends. So amazing, like 19-cent increments. They're not legally obligated to pay me that dividend. They can keep it and reinvest it in the company. Now, let's put this in perspective, though. If you guys all own shares in my company, and we're profitable, and we're making money hand over fist, and I have the money to pay you guys dividends, but I choose not to, are you going to be happy? You're going to vote my ass out is what you're going to do. You're going to vote for the people on the board who are giving you what you want. In terms of maturity, a loan eventually gets paid back. Sooner or later, you're out of debt. With a stock, that's perpetual. You can buy and sell shares, but it never goes away. Once somebody owns a share of stock in your company, you can try to buy it back from them, but they don't have to sell it to you. And then we get into taxing. If you owe money on a loan, for example, if you owe money on your debts, the interest is tax deductible. You don't get any tax benefit from shares of stock. Let's see if I can move this up here. That's way better. All right, let's keep going. So guys, in common speak, if you're buying money on the markets, if you're buying stocks or bonds, those are securities. We as companies issue stocks or bonds to raise capital and to be able to make money to expand our companies or do other things. That's why we do it, guys. And again, equity. People own part of your company, like stocks. If you're in debt, you have a bond, and people essentially owe, or let me rephrase it, the company owes people money. With me so far, guys, we have talked a lot, and it's 9:30 today, so it is time for a sip of coffee, and it is time for our first question of the day on this Friday that normally would have been the last day before spring break. So I understand the feelings of disappointment in your heart. Yes, Nicole?
Me and my friends were talking about this stuff, and
That's an excellent question. The question is, we've got the United States and Mexico, two nations right next to each other, and we say that the United States is richer than Mexico, but we have more debt. That's a really great question. I think that the question of wealth comes down to how well you can maintain it. And here's how I'm going to answer that question. Right now, as the largest economy in the world, also the economy in the most debt, we are simultaneously the richest and the poorest. Right now, the reason that we are able to continue operating the way we do is because other countries continue to extend credit to us based on our expanding economy. Right now, our economy is expanding by about 1% to 2% per year. If we slow down at all from that, if our economy starts to contract, we're going to reduce our total amount of power to attract lenders. And at some point, we're not going to be able to pull in external cash or get loans. If that day comes, some folks like China and Great Britain may come knocking on our door and say, we want our money back because you guys are no longer a good risk. So in essence, it could be argued that a country with a smaller economy but less debt actually is richer than the United States. The reason we say the United States is richer is because we still have more borrowing power. Does that make sense? It's an excellent question. And by the way, nobody has ever asked me that question before. I personally, a lot of people, it depends on which economist you talk to. Some economists have no problem with perpetual borrowing. I think we're in a bad spot. I really feel that at this point, if we don't take some action on our expanding debt, we're going to be leaving future generations with one hell of an amount of debt to pay back and a bad situation. So I do think, I hope your generation takes it seriously that we do need to really start dealing with this debt. Anybody in this room, by the way, or in Zoom land, know when's the last time the United States had a balanced budget? In other words, when was the last time we were in the black? It's before your lifetimes, 2000. The year 2000 is the last time we had a balanced budget. What happened in 2001? It was a defining moment for America. What was it? 9/11. And here's what happened, guys. And this is not a political statement. This is an economic statement. No politician in the world wants to raise taxes. Some people will say, yeah, we're going to raise taxes on the rich. Ultimately, nobody wants to raise taxes on the middle class because they're voters. And those folks vote people in or out of office. So instead of raising taxes to fund 2 wars, we ended up doing them on credit. We basically have been paying for 2 wars on credit. And that's a big reason why our national debt is where it's at. So it's not a political statement. That is an economic statement. So we got a problem. We got to pay it off. Excellent question. Any other questions before we continue, guys? Well, here's the deal. We're going to get through a couple more slides before I treat you to a little spring break today, because I'm going to get you out a little early today. Guys, in terms of how we invest, at this point in time, you guys essentially are using online apps to be able to do this. I know a bunch of you are playing the markets. Traditionally, we would go to somebody who was an investment banker if we wanted to finance our company. They would help us take our company public or to get a bond issued. Stockbrokers, for example, help individuals or companies buy stocks in other companies. And online trading is what's knocking this all out, because nobody's calling up a stockbroker anymore. We're not going to Stratton Oakmont Investments and calling them up and asking for some penny stocks. We're going on to Chase. We're going on to E-Trade. We're going on to Robinhood, and we're trading ourselves. It's shaking up the market. We call these folks amateur investors. So what are some key terms here, guys? There is one time, remember this from today, guys, there is one time and one time only you can buy stock directly from a company. And it's called the initial public offer, where IPA is a delicious India Pale Ale, which I'll definitely enjoy this evening. An IPO is an initial public offering. That's the one time you can buy stock directly from a company. After that, the stocks end up in what we call the secondary market. And that means you got to go through a retailer or a dealer to be able to get the share of stock. Now, by show of hands here, actually, I want to see you guys for this one. How many of you guys have ever heard of a stock split? Does anybody know why companies split stocks? Well, So I'm going to give you the second part of the question, and I'm going to show you a video that's going to answer why companies split stocks. But let's say, for example, let's split the class right down the middle, and we all, in this class, half the class owns 100 shares of Kent Tompkins Chicken Shack. The other class owns 50 shares of Kent Tompkins Chicken Shack. And let's say we decide to split our stocks. So the folks who had 100 shares now have 200 shares. The folks who had 50 shares now have 100 shares. Did the percentage of ownership change at all? No. We still have the same percentages. We still have the same amount. I still have one side who owns twice as much stock as the other. So it doesn't change percentages of ownership. What it can change, however, is the amount of shares in circulation, and it can also change the share price. So stick with me for a second, guys. I'm going to bring up a video for you that I think does a pretty nice job of explaining this concept, because a lot of people ask why do companies split stocks in the first place, and I think this is a pretty good explanation.